At Goldleaf, we're committed to consistently adding value for our clients. As part of that commitment, we're excited to present another video to you today. In this video, we sit down with David DePastena from Dynamic Funds to get his insights on the recent tariffs and how they'll affect the markets. At Goldleaf, we're constantly analyzing the markets to identify opportunities. We understand the best way to predict the markets is to best understand the history of them. We hope you enjoy the video, and we look forward to talking with you soon.
Let's take a review of how tariffs have affected Canada in general. As Canadians, we know that this is not the first time that tariffs have had an impact on us. In 1982, we had lumber tariffs. In 1996, we also had lumber tariffs, but many people forget that in 2018, we had steel tariffs. Now, no one really knows what the future of tariffs will be in North America, but if the current situation rhymes a little like the past situation, where we have tariffs on certain things, we can see that the 5-year growth rate in the TSX, the Toronto Stock Exchange, where Canadian stocks trade, was actually very muted. So all things being equal, even though the markets are very volatile these days, given the past, we've only seen positive returns. So that could mean that this selling right now could be overdone. And even though these are very low numbers and this has a compounded 5-year return, the selling might be overdone or it might be just right. But we can see that from past tariffs, if we have a situation that resembles the past, that maybe the situation, this volatility has been overdone. And we can see this through the past within the S&P 500, the stock market in the US, where when Trump came into his first term, we can see that the volatility, so volatility as measured by an index called the VIX, spiked up, as we've seen recently, and then came down. What this tells us is that these types of movements in volatility, which means rapid, sharp declines, are usually short-term. Canadian companies are actually in really good health and potentially can sustain some of these tariff threats. And really good companies are able to pass on those cost increases to their end users and clients, or they're able to find creative ways to absorb that if they're in a very competitive market. So all things being equal, we know that companies in Canada are pretty resilient. The earnings are pretty strong, and we're looking at a 2025 estimate of strong earnings growth. Of course, tariffs won't help, but we're looking at companies that are very strong going into 2025 and 2026. Of course, things can change. We can see that the worldwide interest rates are being cut, and that's always a positive for markets because it's a lot cheaper for companies to invest. And if we think about double-digit returns and how the stock market reacts to interest rate declines, well, generally we can see that it's very positive. And so what this shows us is lower interest rates is good for the market. We can probably expect the Canadian Central Bank to make some moves internally. If the volatility of the market goes up, that might mean 2 or 3 rate cuts. We don't know. But all things being equal, when push comes to shove, as we saw during the financial crisis, if there is a crisis, interest rates are a tool that central banks can use, and lower interest rates tend to be better for markets. But we also can't discount the fact that we've had some really good markets. And I want to bring a point that just because we've had double-digit returns in the markets, specifically here in the US markets, that doesn't mean that we won't have good returns. And so remember, past performance is not indicative of future returns. But if we look at years where we had double-digit returns, the average return of that year was 12.3. So we can't discount the fact that we could be in a multi-year bull market of double-digit, even if we have a significant volatility. And if you haven't heard of ChatGPT, of course, generative AI is by far the most popular technological adoption ever. To put it in perspective, in the amount of time it took the internet to be adopted in 5 years, it took 2-3 months for something like ChatGPT to be adopted. And even research is showing that tools like ChatGPT or generative AI can help the average employee save 7.5 hours per week. And that's tremendous. That's a lot of cost saving. That's very positive for companies that are looking to save costs, especially in a world of tariffs and inflation. And that could be what helps companies actually save money in the bottom line. Of course, the AI boom is real. We're seeing real companies talk about it, and potentially this is mirroring what the internet looked like in 1992, where it was the beginning of the internet, and this is the beginning of AI. I think this is a very important slide because it demonstrates that on average, the average correction every year is 13%. So if someone were to ask me in 2025, are we going to have a correction? Most likely. And almost every single year since the early 80s, we've had a correction every year. And now currently we're anywhere between 10 and 15% on the North American markets, depending which one you're looking at in the time period. But we are still in the average, and corrections are actually healthy for markets. Now, of course, tariffs are not as good, and the market's telling us that. But keep in mind that this is quite normal as far as the correction up to now. And of course, the question always becomes is, should I invest for the long term? And should I put my money to work? Well, what this shows us is if you were to buy a balanced portfolio, a balanced fund as an example, and you were to put money to work, what this shows us is that 70% of the time in rolling periods, between 3 months, you can take any 3-month rolling period, would your money have been positive? Well, what's really interesting is anybody who has a 3-year time horizon and higher has actually been up. What that really means is that if you have a longer time horizon, the odds of you having a positive return in the next 3 years is pretty high, right? Statistically, this shows us 100%, but let's say it's pretty high. That means that if you have a longer time horizon and you believe that markets have the potential to go up in the next few years, and this is a buying opportunity, then maybe it's time to talk to your financial advisor and put money to work. Well, of course, Trump tariffs have created uncertainty. We can see the stock market is not liking it very much. To put it in perspective, if we take COVID out of this situation, and COVID was an exceptional situation, the current situation is the most uncertain we've ever seen in the recording of this graph. But that also means that the uncertainty is what's actually driving the volatility, not the actual tariffs themselves. What I think is when we gain more clarity on these tariffs, when we gain more clarity as to what Trump wants and the government here in Canada, who's going to be in power, the markets will settle and the markets can decide where they're going to go. But uncertainty creates volatility, not the actual numbers, quite often. So once we have less uncertainty and we have clarity of where things are going, the markets could have some very significant returns to bounce right back where we were. Now, of course, I always say you want to follow the behavioral indicators. And so what's a negative behavioral indicator, especially for businesses, is hiring and capital investment. And that's not something that's very positive these days. Companies are in a wait and see. And that is that's a negative for the overall stock market, of course. If companies will decide how to allocate their capital based on certainty. Now, there's an uncertain environment, so they're not firing too many people, okay? But they're also not hiring very many people. And so what we're seeing is a hiring freeze. We're not seeing huge, massive layoffs, which is kind of good. But I think that companies are in a wait and hold pattern, which is not good for the economy, and also not expanding their companies either. Everybody's kind of in a wait and hold. And we can see that from the consumer as well, because the average consumer thinks the economic future is very dim. And so what we're seeing from a behavioral indicator, and I always say behavioral indicators tell us what's really going on in the economy, is that everything is in a wait and see. And so we'll probably see very flat growth in Canada, or even negative growth. Technically, that would be a recession if we have multiple quarters. But all things being equal with the current information we have right now, unlikely to be a very severe recession. Of course, I said layoffs are weak, and so that's a behavioral indicator, but there is no hiring as well. I want to bring your attention to one of the final points is the Mag 7, which are the 7 biggest companies in the US, now represent 75% of the returns. And I want to bring back to anybody who's ever heard of a company called Nortel, which represented 30% of the Toronto Stock Exchange. And I want to bring your attention when we look at the investing in the market, what's important to think about is consistently getting into the market. And so that dollar cost averaging theme we saw at the beginning is something I always bring to the forefront, because if we were to compare the perfect Betty investor who always calls the market bottom, well, as compared to Tom Tick Tommy, who is terrible at calling the market and always gets in at the end, and compare that to Steady Eddie. So if we have three investors, one that calls the bottoms, one that always gets in at the wrong time, and one that contributes regularly, well, Steady Eddie outperforms all of them. And that's refreshing, because the only thing we need to think about when we're thinking about timing the market is putting money to work consistently, monthly, and regularly. And that allows us to be way ahead and create real wealth. And of course,